It's been a few months since I last posted my monthly investments, back when my portfolio looked like this, and it kind of felt like the world was falling to pieces. Now, we took a couple of months away from YouTube just because the editing took up a bit too much time, but I'm happy to say we're back and with an editor, and here's how my portfolio is looking now. So it's been an improvement, despite all the drama earlier this year. And that's why every month for the past 5 years, I've put some money into my investment portfolio when I get paid, come rain or shine. So in this video, I'll walk you through the accounts I use, the stocks and funds I invested in, and why I chose them. And if you'd like to stay updated on my investments and portfolio performance, be sure to hit subscribe. Now, let's get into it. There are two types of investment accounts that I contribute to every single month, both of which come with tax advantages in the UK. The first is a self-invested personal pension, also known as a SIP. And since I'm self-employed, this is basically my version of a workplace pension that most people will automatically be enrolled in by their employer. I keep my investments very simple here. At the minute, I just add £1,500 directly to the Vanguard FTSE Global All Cap Index Fund, which I did once again this month. This invests in thousands of small, medium and large companies all across the globe. And I want to keep this account pretty simple and well diversified. You know, since it's effectively my retirement pot, I don't really want to be going around taking unnecessary risks. I also don't want to commit to having individual stocks that I know I'm going to have to monitor for decades. So it's just a pot of money that I'm hoping to grow in the background, ideally with minimal effort. However, there is one place where I do invest in plenty of individual stocks, and that is a stocks and shares ISA, which is currently my largest and main investment account. Investing using a stocks and shares ISA allows me to invest without having to pay any tax on gains or dividends. And crucially, it doesn't lock my money away, unlike a pension, which does lock your money away until the age of 55. And that age is set to rise again to 57 by 2028. Now, since it's been a few months since I made a video like this, before I get onto the investments I bought and sold, I want to quickly outline the approach that I take when it comes to investing. I have a long-term view, meaning I aim to invest in companies for at least 3 years. I always try and look for the highest quality businesses out there with strong, sustainable competitive advantages, ideally in important and emerging industries. And I'm also a big fan of founder-led businesses, especially when the management team own a good chunk of shares themselves, meaning they have plenty of skin in the game. With that said, let's get on to the investments I made this month. First, I topped up my existing investment in new holdings with £300. And I think this is probably the first time that I've mentioned new on this channel because it's a fairly new position that I've only really started adding to in recent months. And as a quick overview, Nubank, which trades on the stock exchange as New Holdings, is one of the largest digital banks in the world, with over 120 million customers across Brazil, Mexico and Colombia. It started out in 2013 with a simple no-fee credit card, but has since expanded into a full financial super app, offering everything from current accounts and personal loans to investments, insurance and even crypto. Shock, it feels like all digital banks go into that eventually. Now, as of today, it serves over half of Brazil's adult population, and it's also scaling rapidly in both Mexico and Colombia, making it one of the fastest growing and most profitable fintechs globally. The rapid scale is impressive, but the really exciting part isn't just customer growth. It's how much more valuable each customer becomes over time. The key number I look at here is something called RPAC, which stands for Average Revenue Per Active Customer. In the most recent quarter, Nu's monthly RPAC hit $12.20. To put that into perspective, back in 2021, it was around $4. So in just 3 years, Nubank has tripled how much revenue it brings in each month from its average active customer. And it's not slowing down. If you look at the cohorts, meaning groups of customers who have been with Nu for different lengths of time, you can see that the longer they stay, the more they're worth. On average, customers who have been with Nubank for a year bring in around $5 in revenue each month. By year 3, that rises to around $9, and by year 5, it's just below $14 a month. And by the 8th year, the most mature cohorts are now generating $27.30 per month on average. And that upper limit is still increasing over time. It was just $26 last quarter. And if you compare that to the big incumbent banks in Brazil, where the average RPAC is $40 per customer, you can see that there's still more room to grow. This happens because most Nubank customers don't stop at a single product. Sure, most customers will start with a current account or maybe a simple credit card. Then, as trust builds, they might add personal loans, they might start investing, they might buy insurance, or perhaps they'll use Nu's crypto features. They might also start a small business and decide to open their business account with Nubank. And each extra product that a customer adopts pushes their monthly revenue higher. But what makes this even more insane is that Nubank's cost to serve a customer remains basically flat at 80 cents a month. It doesn't really matter if the customer has one product or 5. The marginal cost barely changes. So as this average revenue per customer rises, almost all of it flows straight through to the bottom line. Now, of course, there are risks too. Nu is still a bank, so it has to underwrite loans carefully. A sharp change in interest rates or a spike in defaults could really hurt them. And being heavily exposed to emerging markets in South America does carry more macro risk. But from everything I've seen, I think Nu's credit quality has held up well, its balance sheet is strong, and its unit economics are best in class. At the current share price, the stock trades for about 20 times next year's earnings, but analysts expect earnings per share to grow by more than 30% a year for at least the next few years, making the valuation look extremely attractive for a business that already looks fantastic. I think it's possibly the most compelling growth story in my portfolio right now, so it was an easy decision to add another £300 to my existing investment. The next investment I made was in Alphabet, the parent company of Google and YouTube, where I topped up £100. This was actually before the recent outcome of a court case where the market had been scared for a while that Alphabet might be forced to sell Google Chrome. But surprise, surprise, this didn't happen. So shares have actually been given a bit of a boost since I bought them. But this threat was one of 2 things that I think has been holding Google stock down over the last year or so, with the other being ChatGPT and Google basically losing the AI race. However, I now think both of these headwinds are kind of evaporating. I mean, clearly the breakup one has, for now at least. But let's touch on those AI fears. Because when ChatGPT launched in 2022, I think a lot of people thought it might be the beginning of the end for Google search. If you can just ask a chatbot a question and get an immediate answer, why would anyone bother looking through all the websites listed in Google? And I'll admit, even I found myself using ChatGPT a lot more and having these fears for Google as a business. But nearly 2 years on, that fear hasn't really shown up in the numbers. In its latest quarter, Google search revenue grew nearly 12%, which is accelerating from the quarter before, and it's continued to post double-digit revenue growth as it's done pretty much ever since ChatGPT was launched a few years back. Not to mention YouTube and Google Cloud continue to put up impressive figures. So to me, these are not the numbers of a business that is being disrupted. In fact, Google's own AI features seem to be driving engagement higher. The new AI overviews in search are now used by over 2 billion people a month, and Google says that they've actually led to a 10% increase in engagement. That means people are spending more time in search, not less, and advertisers are paying for those extra eyeballs. Plus, Gemini, Google's flagship AI model, has also picked up 450 million monthly users, which is catching up pretty fast to ChatGPT's 700 million. And what's crucial is that Google has something that few AI players do: the entire technology stack. So most companies building AI are reliant on NVIDIA's GPUs and someone else's cloud infrastructure, which is incredibly expensive. Whilst Google does still need NVIDIA's GPUs for some things, it also designs its own tensor processing units, which are super efficient for heavy AI workloads. And it runs its own data centers, it has DeepMind and Google Research pushing the science forward, and it can instantly roll out AI products to billions of people via search, YouTube, Gmail, Maps, and Android. That means its cost per AI query is far lower, which gives it a structural advantage over almost anyone else. So while the market worried that AI would be a threat to Google, I actually think it's becoming a massive tailwind. And despite the recent jump in share price, I still think it's quite attractively valued at about 23 times next year's earnings. And I'd say Alphabet still appears cheaper than most of its mega cap peers. So even though when I invested there was still uncertainty from the antitrust decision, it remained a pretty easy stock to add another £100 to. Alongside those individual stocks, I also added £200 into my global pie, which is made up of 2 ETFs. 92% is in the Spider MSCI All Country World ETF, which covers thousands of large and mid-cap stocks all around the world. And 8% is in the iShares MSCI World Small Cap ETF, which gives me exposure to smaller companies around the world as well. This is the core of my portfolio. It's globally diversified, passive, and more steady than the fast-growing individual companies that I invest in. I think right now it makes up about 20 to 25% of my ISA, which is roughly the balance I want between my core and my higher conviction satellite positions. Now, pies are just one of many reasons why I've had my stocks and shares ISA with Trading 212 ever since I started investing. And I want to say a quick thank you to Trading 212 for sponsoring today's video. Now, the main reason that I've used them for the last 5.5 years is their super low fees, which allow me to keep more of my returns. And the ability to start investing from as little as £1 was very helpful when I was just starting out. So if you'd like to try them out, you can use the code SNS bonus to get free fractional shares worth up to £100 when you sign up. The other big addition this month was Duolingo, where I invested £300. Now, this one has been pretty frustrating recently as a shareholder. The company delivered exceptional Q2 results in August. Revenue grew 41% year on year, which smashed analysts' estimates of 35% growth. Daily active users were up 40%. Paid subscribers rose 36%. Profits were strong. And the guidance was also comfortably ahead of analysts' expectations. And yet, the share price has been basically cut in half over the last few months. Investors seem to be worried that AI tools like ChatGPT or the revamped Google Translate will make Duolingo obsolete. But I think the market is maybe making the same mistake here that it made with Alphabet stock, thinking AI is a threat to a business when really it's a potentially massive tailwind. Because Duolingo is already integrating AI to make its product better. For example, the company's Max subscription lets you roleplay conversations, get instant explanations of mistakes, and even practice speaking with AI-powered video calls. And independent studies show that this feature materially improves speaking skills, which is one of the hardest parts of learning a language. Ironically, the only AI headwind that I think it faced in the quarter came from a poorly worded LinkedIn post by the co-founder and CEO Luis von Ahn, where he said Duolingo was becoming an AI-first company, which some users misunderstood as a company that's basically going to fire everyone and replace them with AI, which is not the case. But it did hurt Duolingo's viral social media marketing, and the company even saw some boycotts in the United States. It hurt user growth a little, but it's already getting back to normal. Now, the market might be focusing on the other AI threats, but I think it's missing the point. These simple tools are no match for Duolingo. To actually learn a language, you need structure, repetition, and motivation. That's exactly the learning feedback loop that Duolingo has built. And the streaks, the gamification, the little nudges to keep you coming back, plus the obsessive A/B testing to drive better outcomes, those aren't things that a general purpose chatbot are designed to do. It might feel bad, but I guess I should be happy because this allowed me to add another £300 to this company on the back of very strong results at a much cheaper share price. And I also put another £100 into Games Workshop. This is a name you'll probably keep seeing in these updates because I'm slowly building out the position over time. Now, Games Workshop is the UK company behind Warhammer, and I think it's one of the most brilliant, lesser known businesses that we have here. It has a powerful, vertically integrated model. It creates the games, manufactures the miniatures, sells them directly through its own stores and website, and then licenses the intellectual property for video games and films. The fan base is incredibly loyal, margins are strong, and with an Amazon series starring Henry Cavill in development, there's a chance of the Warhammer universe reaching a whole new audience. But to be honest, even without this Amazon series, it's still a year or two away, you still have a high quality business that continues to expand its niche with plenty of future avenues for growth. So I was happy to continue building out this position with another £100 added this month. So to recap, here's how I invested this month. £1,500 went into the Vanguard FTSE Global All Cap Index Fund within my pension, and within my stocks and shares ISA, I put £300 in new holdings, £300 in Duolingo, £200 in my global pie, £100 in Alphabet, and £100 in Games Workshop. We'll be back and doing these updates every single month, so if you'd like to follow along with our investing journey, don't forget to subscribe. Thanks a lot for watching, and I'll see you next time.